the dollar that the Federal Reserve cannot control. Most people assume that the Federal Reserve possesses absolute control over the creation, circulation, and value of the United States dollar. However, the vast majority of the world's dollar-denominated transaction volume does not occur within the borders of the United States, nor is it subject to the regulatory oversight of the American Central Bank. Instead, global commerce is run by a massive, offshore monetary system known as the Eurodollar market. A Eurodollar is simply a U.S. dollar-denominated deposit held in a financial institution outside the United States, whether in London, Tokyo, Zurich, or the Cayman Islands. Because these deposits reside outside the jurisdiction of the Federal Reserve, they are not subject to domestic reserve requirements, deposit insurance, or federal banking regulations. This unregulated shadow currency operates entirely on the ledgers of international banks, serving as the invisible foundation of global liquidity and trade. The Cold War origins of the shadow dollar. The birth of the Eurodollar market was not the result of a deliberate financial policy, but rather a consequence of geopolitical tension during the early years of the Cold War. In the 1950s, the Soviet Union earned significant amounts of U.S. dollars through its commodity exports. However, the Soviet leadership feared that if they deposited these dollars in New York banks, the United States government could easily freeze their assets during a geopolitical crisis. To mitigate this risk, the Soviets transferred their dollar holdings to a Soviet-owned bank in Paris, whose telex address was Eurobank, and later to financial institutions in London. These European banks accepted the dollar deposits and began lending them to other European corporations. In doing so, they created a parallel, offshore market for U.S. dollars that was completely insulated from the sovereign reach of the United States government. The mechanics of offshore ledger money. To understand how the Eurodollar market functions, one must realize that a Eurodollar is not a physical banknote. It is a bookkeeping entry on a ledger. When a foreign bank accepts a dollar deposit, it does not hold physical paper currency in a vault. Instead, it maintains an accounting relationship with a correspondent bank in the United States. However, because the foreign bank is not bound by Federal Reserve regulations, it can use that deposit to create new dollar-denominated loans out of thin air, with virtually no reserve constraints. If a bank in London receives a $1 million deposit, it can lend $10 million worth of credit to a shipping company in Singapore. This process of credit expansion multiplies the offshore dollar supply exponentially, creating a vast sea of digital dollar liquidity that exists entirely outside the official monetary metrics tracked by the Federal Reserve. The engine of global trade and leverage. The Eurodollar market is the primary engine that funds global commerce. Because the U.S. dollar serves as the world's reserve currency, almost all international trade, from oil and agricultural products to microchips and cargo ships, is priced and settled in dollars. If a Japanese manufacturer wants to buy raw materials from Australia, the transaction is typically settled in dollars, requiring both parties to access dollar liquidity. Foreign corporations, sovereign governments, and international banks rely heavily on the Eurodollar market to secure the short-term funding and long-term loans necessary to facilitate these transactions. The market operates as a highly sophisticated, wholesale funding mechanism, where banks continuously borrow and lend dollars to one another overnight, establishing the baseline interest rates that dictate the cost of global credit. The illusion of central bank liquidity. The existence of the Eurodollar market exposes a fundamental illusion in modern macroeconomics: the belief that domestic central banks have complete visibility and control over global money supply. When the Federal Reserve adjusts interest rates or executes quantitative easing, it is manipulating the domestic banking system. However, the size of the offshore Eurodollar market is estimated to be multiples larger than the domestic U.S. money supply, though its exact scale is impossible to measure because there are no centralized reporting requirements. This vast pool of unregulated capital operates independently, often neutralizing the domestic policies of the Fed. If the Federal Reserve attempts to tighten credit inside the United States, global banks can simply access the offshore Eurodollar market to continue generating dollar-denominated loans, undermining the central bank's ability to control inflation or curb systemic leverage. The hidden plumbing of the 2008 financial crisis. While the public narrative of the 2008 financial crisis focuses on subprime mortgages in the United States, the crisis was structurally a systemic run on the Eurodollar market. In the decades leading up to 2008, European banks had accumulated trillions of dollars in long-term, dollar-denominated assets, specifically mortgage-backed securities. To fund these purchases, they relied on short-term, overnight borrowing in the Eurodollar market. When the underlying mortgages began to default, trust between international banks collapsed. Overnight, banks refused to lend dollars to one another, completely freezing the offshore wholesale funding market. European institutions suddenly found themselves facing an acute dollar shortage, unable to roll over their short-term debts. To prevent a total collapse of the global financial architecture, the Federal Reserve was forced to establish central bank liquidity swap lines, printing trillions of domestic dollars and shipping them offshore to rescue foreign banks. The dollar shortage trap. The structural reliance on the Eurodollar system creates a dangerous, recurring trap for emerging markets and foreign corporations. Because global debt is overwhelmingly denominated in U.S. dollars, foreign entities must constantly earn dollars through trade or borrow them through the Eurodollar market to service their liabilities. However, when the global economy enters a downturn, or when the Federal Reserve raises interest rates, global liquidity contracts. Investors pull their capital back to the safety of the United States, causing the value of the dollar to rise sharply. This dynamic triggers a severe offshore dollar shortage. As the dollar strengthens, the cost of servicing dollar-denominated debt increases exponentially for foreign borrowers whose revenues are in local currencies, forcing many emerging market nations into severe debt crises and currency devaluations. The future of the shadow monetary system. Despite ongoing discussions regarding, quote, de-dollarization and the rise of alternative financial blocks, the Eurodollar system remains deeply entrenched as the primary nervous system of global finance. Its decentralized, credit-creating architecture is incredibly resilient, having survived geopolitical shifts, regulatory crackdowns, and global financial crises. No other currency or system currently possesses the depth, liquidity, and legal infrastructure required to support the sheer volume of global trade finance. As long as international banks and corporations require a neutral, highly liquid medium of exchange to conduct business across borders, this shadow currency will continue to operate quietly in the ledgers of offshore financial institutions, secretly dictating the trajectory of global inflation, interest rates, and sovereign power.